Good morning, everyone. My name is Keith Edwards. I'm a technical consultant for Red Cloud Klondike Strike, and this is our second podcast. So first of all, I wanted to start off by just a little brief overview of the overall markets. And what we've been watching here for the last month and a half is the large cap US indices in particular, the Dow and the S&P, are working their way back up towards the upper boundaries of the trading range that they have been in since the peak in January and the lows that we saw in February and March. Now, they are the laggards actually of the market, and we'll get to that in just a second. But we do have the S&P very close to the interim channel top, which is at 2,800, and if it can get on the other side of that, it should move back to the January high at 2875. The Dow is at 25,380, and that's the key level on the interim trading range. And if it gets on the other side of that, we should work our way back up towards 26,700, which is the January high. Now, obviously, above that, everything's going to be wonderful and the utopia will happen in the United States. We deal with that later on. What we're seeing is that the US dollar, which has been rallying for the last month or so, it's stalling a little bit right now, but I don't think it's anything serious, has kept the international markets at bay, and that is what has impacted the Dow and the S&P and sort of kept them sort of behind the eight ball. Where the real action in the US is taking place is in the small cap, more domestically oriented US stocks. And we've seen the Russell 2000, the S&P 600 small caps, and the S&P 400 mid cap indices all break to new all-time highs. So all the money seems to, well, I shouldn't say all the money, but a large chunk of the money in the US has got spread out into a broader base of stocks. And when you look at the group and sector breakdown for the Russell 2000 and the S&P small caps, roughly 8 of the 12 sectors are all booming like crazy down there, and they are all leading the show. When you come back to the broader indices like the Dow and the S&P, well, there's one sector that leads, and that's the technology side. The Americans are just obsessed with technology stocks, and the charts are basically positive, so there's reason to be positive on them, but they are basically running away with everything in the US, and it's closely followed by consumer discretionary, which is really Amazon. So those are the two sectors that are really driving the big large cap sectors. The smaller cap side of the market is broad-based across almost every sector. They still look strong. They still look like there's higher levels coming. So we want to be positive towards that. Now, underneath the whole thing, we are starting to see a lot of groups and sectors starting to come to life. You know, we're getting better action out of industrials. We're even seeing some of the healthcare sectors picking up. And one notable area that we have an interest in is what we're seeing in the material sector. I think the really big thing here with commodities and with the material sector is to have some patience. I think that the markets are going to go into their typical summer slumber across the board. And I frankly wouldn't be expected that July and August are pretty quiet and not doing an awful lot, just a lot of underneath the surface building and improvement. And that's what I'm already starting to see within the commodities area. The metals have picked up. They seem to weather these recent tariff trade things without really any damage at all. And one of the things that struck me in some work I was doing over the weekend was that the commodity markets seem to have weathered the strength in the US dollar very well. And usually when the US dollar firms, it just kills the commodities. It's put a lot of pressure on gold, brought it right back to a key support area around 1280 to 1300, and it's beginning to base in that area. And that's a good sign. But what I'm seeing in the metals, what I'm seeing in some of the agricultural sides is just gradual improvement. And there's certain things I'm looking at, the moving averages and the way they're configured, the way the momentum indicators are acting, and things like that. They're just not all correctly in place yet. And that's why I think we need a little patience to just kind of let this thing sort of unfold. And I think things will be considerably better for the commodity area as we get out into August and into September, October. We saw, for example, this morning the PPI was stronger than anybody had anticipated. I think that's the sort of thing that we're going to be seeing as we move along, that the CPI and the PPI are going to be firming. My commodity stuff has all been building really nicely. I think back to my days at Nesbitt Burns, and one of my good friends there, Don Cox, and he and I used to have wonderful discussions, and Don coming from his very broad perspective and me looking at the technicals and that. But one of the things Don always talked about was you have to look at situations sort of from the point of view of a newspaper. You want to be buying the names that are starting to show up on pages 15 and 16 in the newspaper, because they're the ones that are growing and will rise up through the paper till they reach page 1. By the time they get to page 1, everybody's talking about them, and that's when you should actually be selling them. And I thought that was a great little way to look at the markets. And when I look at what I'm seeing in the commodities and the metals right now, they look like about a page 15 story to me. So we've still got a bit of work to do, and I think that that will continue over the summer. And I think the real good time for a lot of the commodities, and again, I'm not just talking about energy, I think the metals are going to do particularly well, and I think it'll bleed over into agricultural sides too. I think that really gets underway as we get into August and September. So stay positive, but be patient. Allow things to unfold. It's not like the media talks. It's not like the algorithms and high frequency traders talk that everything is going to happen instantly. It's not going to do that. It evolves, and we have been in a consolidation pattern since the beginning of the year, and I don't frankly think we come out of that consolidation pattern until we get into September. And I think after September, I think we could have a pretty good rally in the markets, and we could see some dramatically higher highs. And that includes the Toronto market, which seems to be just hell-bent right now to get back to its old high. And it's sort of trying to be like the Dow and the S&P, and to a certain extent like the Russell 2000, and that is be a player in the game. Now on the universe of stocks that I follow for Red Cloud, I'm seeing a lot of base formations. I'm seeing a lot of consolidation patterns, and this is exactly what I would expect to see given what I am seeing in commodities and metals and even energy. So there are a number of names that are starting to bubble up, and I think we're going to see more and more of these names come to life over the next couple of months. So I would encourage people to be positive, accumulate names, and basically don't look for everything to happen instantly. I think as we get over the summer and start into the fall, I think we'll all have smiles and be quite happy with what we're going to see. Everything seems to be headed in that direction. Okay, with that, I will end this podcast, and we will rejoin you in the next few weeks to update everybody as we see the technicals unfolding. Everybody have a wonderful day.